Welcome to Subramani. I was seeing the portfolio of 2-3 mutual funds in the BFSI sector, and there were many companies which I wouldn't have ever bought them, but those funds have not done too badly, which led me to think that apart from the NBFCs and banks which I am holding, I can also hold a fund which holds some of these shares. So some of those shares are beyond reach. Some of those shares are something which I will never buy on my own. Some of the shares I could never have identified on my own. So these are the reasons why I would hold those funds. Even though it is BFSI, where I consider myself reasonably astute as an investor. So if I have many banks, if I have NBFCs, if I have some AMC, some insurance companies, etc., am I better off investing in a BFSI fund? Having asked that question, same question can I ask, am I better off investing in an energy fund rather than in energy companies? Because the energy companies which I bought for a very specific reason, that I was getting anything between 5 to 20%. Repeat, 20% dividend yield. I think at 117 rupees when I bought Coal India, the dividend was almost 20 rupees. So it's almost 20% dividend yield. Today the reasons for which I bought those shares is completely lost, simply because the denominator has grown multifold. So is it better off selling those shares, paying the taxes at 12.5% and putting money in an energy fund? Why was this trigger? Is because I read a report, I'm not sure which from where I read the report, but I read a report about some art dealers in the 19th and 20th century, that they went around the countryside just buying a lot of art. They just bought all the art that they could lay hands on, knowing fully well that some of them would explode and some of them would do very well, and all of them made fortunes. They made a lot of money in buying the art in various places. Now, I also read a report by JP Morgan, I think, where they have analyzed the returns that the equity index gave from 1980 to 2014 in the US. 64 companies went FUD, almost 64% of the companies went FUD, but 7% of the companies hit the ball out of the park, using their own language, which was enough to give them a, this is I think the Russell 3000, where they got 50x, right? So in 34 years, if your portfolio grows up 50x, I think on a TRI basis, you have done extremely well. If so, should you put money in a fund, in an index or in any of such funds, knowing that 60% of the calls by the fund manager will be wrong? Not because he is wrong, but because the fund is composed of some such shares which could go FUD. But if he or she picks up enough shares which hit the ball out of the park, if they pick up some 100 bagger, I mean, which becomes a 100 bagger in 10 years or things like that, will that return be greater than the returns that you can get? Because if you don't get those 7, if you get anything out of the other 93, there is a very good chance that you will underperform the index with higher stress and higher standard deviation. This is a question which is very difficult for all of us to answer. So whether it is investing in the overall index of the country or over index of the index of the world, because there is no way how you can know whether to sell in China, buy in Japan, sell in Japan, buy in China, buy in Taiwan, buy in Korea, maybe buy in Europe or US. You don't know what to do. For example, today it is fashionable to criticize China and say in 2024 China has done very badly. Of course it has done very badly. 2000 to 2024, I think the market is down more than 50%. And the government is doing everything that it can, including arresting investment bankers, to stop the fall, but the market is not stopping. But remember, the growth in China is likely to be better than the whole of Europe. Individually, if you take each European country, none of them will grow as fast as China. Maybe US also will not grow as fast as China, given the size that China has. That is really commendable. Assuming even for a minute that the best three markets to invest today are US, China and India, for you to make those switches as to how much in China, how much in US, how much in Taiwan is very difficult. So if you have a fund which goes and invests in international indices, maybe replicating the MSCI index or something like that, maybe you will be better off, because there is no way how you know how to switch, and it is also very tax inefficient if you switch. So putting money in a fund which invests in global indices, just global indices, it could even be a fund which switches, which is an actively managed global fund. You could put some money there. You could also put money in an actively managed specialty fund. Specialty fund means focus fund. So that fund will decide when to invest in pharma, when to invest in BFSI, when to invest in something else, maybe steel and metal, right? They will choose when to invest where. That is also not a bad option, because these are things which is very difficult for you and me to do. Do I want to name those funds and those fund houses? No. Answer is no, because when they do approach me, I act very haughty and say, I will not take money for naming you. So I don't want to name them without taking money or with taking money. So I will not name them. It is for you to go and do the research. I stick to a few fund houses that I think I've said enough number of times. I can't go and retrace what I do. But there is a risk that if the fund manager is not good, he may end up or she may end up buying really bad stocks. So you have to monitor. Don't think that you can just put money in one or two good funds and go to sleep for the rest of your life. You can't. You may have to be alert to see what's happening. I've also invested in a commodity fund. Here I think I'll have to name it, which is HSBC, which is giving me reasonable returns, nothing great. But I don't think it's going to do too great because over a period of time it has not done very well. But I'm there in a commodity. I wanted to be in a commodity fund in Brazil, saying when the Brazil market booms or something like that happens, I will participate. But it's an extremely small, insignificant amount of money. But I have some money there. Similarly, I have some money in a REIT fund. How can I invest in global REITs except through a fund? And there is only one fund, so go and search. There's only one global REIT fund, so I can afford to name them. It is the PGIM International REIT Fund, which I think makes sense, because today at 12.5% tax with a dollar designated return, it can't do too badly, and it's a good way of reducing risk in a market where the PEs are so high, at least in India. Similar comparative companies like which are there in say South Korea or Taiwan are today much cheaper than what it is in India. Indian PE is high. So shifting from lower quality to higher quality may make sense. Shifting from individual stocks to funds may make sense. Though of course if you're very sure that you want to put money in say Sun Pharma, you think it's a good buy, then you can put money in a pharma fund or a healthcare fund and buy Sun Pharma. You can put money in a BFSI fund and buy HDFC Bank, right? It does not stop you from doing that. Or you look at some BFSI fund which is not so much into banking, which is into non-banking companies, maybe mutual funds, insurance companies, NBFCs, etc. And then you also buy HDFC Bank. That is if you want to own HDFC Bank. That is different. I have HDFC Bank bought at some ridiculous price of 40 bucks or something like that, and I will continue to hold it for the rest of my life, because Reliance, HDFC, HUL, Colgate, Siemens, Cummins, will I ever go to zero in that? Answer is no. I think the lowest I'll go in terms of numbers is about 1000. Cholamandalam, Coromandel, Carborundum Universal, maybe even EID Parry. Will I ever go to zero in some of these shares? Answer is no, I will not. I will continue to have them in my portfolio, because I believe that I've got enough returns for the rest of my life, so I will just stick to them. But do I have too much of a choice? Can I sell Indigo and put it into a transportation and logistics fund? No, I don't look at, I am not very happy with what I'm seeing in transportation and logistics fund, so I may not. But I may, after 6 months I may. So that reduces the size of the portfolio, reduces the standard deviation of the portfolio, and may not do something dramatic with returns, but it does one thing: it shifts my income from dividend, which is taxed at 30%, to capital gain, which is taxed at 12.5%. That itself is not bad, but you should not do anything stupid like this, because tomorrow capital gains could go up to 25%, and the differential that you are hoping for is more than lost in the AMC charges, right? I don't need an AMC to hold HDFC Bank and Reliance for me. I can do that myself. So depending on what you want to do, all these things make sense to have some equity and some mutual fund, some direct equity and some equity mutual funds. And in case you are worried that that debt is taxed at a very bad rate, maybe balance advantage funds, right? So some balance advantage fund or multi-asset fund, where you let the fund manager do the asset class shifting and portfolio quality shifting. Right, so you could do all these combinations. These are good things to do in a bull market like this, because when you don't know whether the PE is too high, whether an industry is overpriced, etc., you can get out of that particular ETF, right? Thank you.